Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. The market over the past few months now has been extremely volatile, extremely choppy. A huge number of investors just don't know what is going to happen. If we take a look at the sentiment right now, the AAII bull ratio has been printing some of the most bearish readings in stock market history, right? Since the 1990s here, this is the 50 period moving average of the AAII bull to bear ratio. So the number of investors who are optimistic versus pessimistic on the market. And you can see that at least on this survey, we're at a worse sentiment than the 2009 financial crisis and comparable to the 1990 recession, which is historically known to be a period of time where investors were extremely fearful. Now, of course, sentiment is not everything, and that still begs to ask the question, are the big headwinds that we have in the macro environment right now, declining economic growth, elevated inflation, a Federal Reserve that is committed to creating a recession, it almost seems inevitable. The path of least resistance is to the downside, and that we should not expect the bull run that we've seen since 2009 to continue. And in fact, if we take a look at the bearish sentiment leading to the global financial crisis here, 2008, sentiment was already pretty bearish. So investors got bearish leading up to the global financial crisis. Could the same thing be happening today? That is a very, very good question that I think we need to answer. When is the big stock market crash coming? Now, perhaps it's never going to come. Perhaps the market is going to go sideways in a trading range for the next 10 years, right? That would be pretty painful for a lot of people. But from what we've seen in history, even those types of periods where you have the market go sideways see an incredible amount of volatility with big swings up, down 40%, up 100%. Down 50, 60%. The nature of the stock market is to go to the extremes, whether that's to the upside during euphoric moves up in the market or to the downside during great market panics. And to us, that is what creates opportunities in the market. It is the imperfection, the inefficiency of the market that always seems to go too much to one extreme, like a pendulum that swings from one side to another in an endless and repeatable manner. So in this video, I am going to go through a few charts that will at least attempt to answer the question, when is the big crash coming? When should we expect that to happen? And of course, we're going to take a look at the technical picture right now in the stock market. But let's first remind ourselves of why the stock market has been going down in such an aggressive manner throughout 2022. And a big part of that to us has been the 2-year yield that's been rising very rapidly. That's the equivalent of market expectations of the federal fund rate, right? So it's been a very, very rapid tightening cycle because of inflationary pressures. Now, typically what happens, and we've covered this many times on this channel before, is when you have a peak in the 2-year yield, in market expectations of the federal funds rate, that usually leads the stock market higher. We've seen this many times throughout history where an immediate peak in the 2-year yield triggers an instant rise in the market. And that has happened over and over again throughout history. The dot-com bubble is a big exception, big exception. To us, this can be considered somewhat of an anomaly because of the sheer market distortion of the technology bubble throughout that period that essentially had a euphoric blow off top, unlike anything that we've seen in recent market history. And obviously once sentiment peaked and shifted to the downside, it was a tremendous pressure on the market. And even though the 2-year yield peaked, the downside pressure from a collapse in the technology sector brought the market down. But if we take a look at 2006, 2-year yields led the market higher. And we can see this through this chart. And this is leading me to my next point, is that a peak in the 2-year yield gives stocks a boost initially, right? In the 3 months after, 6 months after, returns are a lot higher than average, with around 20 to 25% median annualized returns between the 3 and 9 month time frame. And then returns start to get a little bit worse when you start to look out further than a year, 15 months, 18 months. And the reason for that, when the 2-year yield is peaking, if we think about why that's happening, why did the 2-year yield peak in 2006? It was because the economy was weakening. Now, initially, that's good because that's usually when monetary conditions begin to loosen, and that provides a reason for the S&P 500 to begin rallying. But if you start to look out further into the distance, after a peak in the 2-year yield, you look out 3 quarters, 4 quarters, or even further, that's when earnings start to really deteriorate. Earnings start to move down and potentially even collapse. And you could very much argue that the tightening of financial conditions that we've seen throughout this year, throughout 2021, throughout mainly 2022, has been so violent, so aggressive in a global economy that's still very much leveraged. If you take a look around the world, a lot of countries are leveraged up. And so you could argue that once we start to feel the effects of that tightening, it's going to cause a massive disturbance in the market, a massive contraction in a similar way to the way rising rates in 2004, 2005, in the beginning of 2006 only triggered significant economic contraction when you started to look out a year into the future. So you could very much imagine a scenario where earnings a year from now begin to collapse in a massive way, and that the rise and the tightening of financial conditions that we've seen throughout 2022 has essentially sown the seeds for what could become one of the biggest contraction in S&P 500 earnings and create a 2008 type of scenario. Now, if your time horizon is within the next 6 to 12 months, then that's not at all our view. Our view is that actually earnings are going to hold up incredibly well right now, and much better than market expectations that are very negative right now. Analysts are expecting earnings to contract, and that is currently baked into the market. I think this is really an article that is key to understanding the market today, and really a research process that I think nobody's really looking at. So we're very proud of this piece and the way we're currently looking at S&P 500 earnings. Go grab yourself a free trial and read through this type of high quality post, which is often followed by technical updates on the price action. Now, speaking of the idea that nobody is talking about this, nobody seems to have an optimistic opinion on earnings. Nobody can think of one reason why earnings could actually rise, even if that means an average earnings growth, right? If you take a look over the long run, earnings go up. That's why there's this joke that the market is supposed to go up forever. It's the earnings that go up forever. That is what drives the market long term. And so you are making a pretty big bet that earnings are going to contract here. And it's an even bigger bet that that is already baked into market expectations. And that even if you have average earnings, we think that could actually send the market back up to the all-time high. But of course, it's not popular to talk about that. People are scared right now as we're at a historical bearish sentiment. If you take a look at the AAII bull ratio. So if you're on CNBC and you want to gain traction, or if you're on Twitter and you want to gain traction, you need to be bearish. You need to look for reasons to be bearish, because that's what the popular narrative is right now. People are concerned, people are scared, fearful, and so they will listen to information that will confirm that underlying emotion, that underlying gut feeling. So you really need to ask yourself, are you expecting earnings to contract from here because you've done the work, you've done the research, and you've identified that there are high odds here that we see an imminent collapse in earnings? Or are you going through confirmation bias because you have an underlying fearful emotion that makes you have a gut feeling of being concerned about the market, which leads you to make irrational and subjective assumptions regarding market dynamics that you would have never made if the market would be trading at all-time highs? And of course, you are welcome to that opinion if you've done the research and you're absolutely convinced by the idea that earnings are going to collapse, and you're making that decision based on fact and odds as opposed to emotion and gut feeling. Then go ahead, and also make sure to drop a comment down below highlighting your entire thesis, because we absolutely want to hear your opinion. But the point is that, individual investors get whipsawed in this type of market. And I do think people can get very much whipsawed, especially short-term traders get crushed by volatility like this. After a 20% move up in the market, CNBC was only doing interviews on guests talking about a Fed pivot. highlighting the good news, highlighting the fact that stocks were showing a lot of strength and that the bear market was over. And a lot of the core arguments that they gave were absolutely true, but the risk reward here was so poor. If you take a look at this article that we posted on the 15th of August, we simply highlighted an overbought RSI reading. It's not rocket science. Risk reward is easy to spot in the market. You have an overbought RSI reading, you know that the market is going to consolidate for a while. That happened several times throughout 2021 and 2020. You don't have to be a genius to understand that that's not the moment to enter the market. We were coming into the 200-day moving average, testing that trendline resistance, overbought on the MACD, overbought on the RSI. It's not rocket science, but it's incredibly difficult to do that on your own and under the influence of everything that's going on the internet, on Twitter, on YouTube, on CNBC, so many opinions. And that's why we have a team that works on the research to prevent us from having this type of bias and hopefully give our members a contrarian outlook on the market. So if you want to test out our service for free, you can test out the 1-week free trial at gameoftrades.net. A lot of people in the comments section are very concerned about the Fed being hawkish. That's why we had a 24% correction. They're unlikely to get much more hawkish from here. And we have a research paper coming out this week highlighting our reasoning for that. That's definitely much less of a risk now. Although if you take a look at yields right now, you can make the case that the 10-year yield here is still hovering near its highs, and the market is somewhat relatively higher compared to where you'd expect yields to be. Now, if yields continue rising here, that's bad news. But again, not our expectation. Now, I think CPI data that's going to come out on the 13th of September is going to be a tailwind to the market. I think it's going to be a tailwind to bonds, meaning that yields are going to come down again. And considering the inverse relationship between yields and stocks that we've had for quite some time now, ever since December 2021, where essentially moves up in yields have created move down in stocks, moves down in yields have created moves up in stocks, and then even more recently, top in the 10-year yield perfectly coincided with the bottom on the SP 500. If you get a big tailwind from a weaker than expected CPI, that could be a tailwind. Now, our job is not to focus on the short-term price action. That's not what the goal of our service is. Our focus is on the 6 to 12-month time frame, but of course we're actively looking at the price action and seeing what kind of developments are happening. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button and click on that subscribe button if you are new here. Now, in the meantime, I wish you good luck on your trading and see you next time.